Buying property is easily one of the most expensive transactions you'll make in your lifetime, but it can yield so many rewards. You just have to understand every financial consideration that goes into buying property, including the tax implications. So don't let FOMO take over your decision-making process, and rather base your decision to invest on these financial factors. Hi, I'm Myssy, founder and director of Myssy Co, a professional services firm based in Sydney. I've been involved in accounting, business advisory and tax for nearly 25 years, and I'm passionate about making high-quality advice accessible to owners and teams of all sizes. Welcome to the next part of our Savvy Business Owner's Guide to Financial Success series, designed to help you navigate the complex world of business. As we all know, the Australian love affair with property continues and has been especially reinforced during the COVID-19 pandemic over the last 2 years. However, while FOMO can overwhelm all other considerations when entering the property market, there are also many important financial considerations. In today's video, I want to help you navigate the world of property and how important it is to consider all the tax implications, good and bad. I'll be explaining the different types of tax you need to know about, the benefits of using the right tax structure, and how to use negative gearing to your advantage. Before I continue, however, please note that this video should not be seen as a reflection on our views of the current state of the property market and thoughts on whether to invest or not. We always recommend that you seek tailored professional guidance to ensure that it takes into account your personal circumstances, objectives, and needs. Let's start by looking at the different types of tax that can impact your property investment. The first one is capital gains tax. This is a tax that applies to gains that you make when you sell an asset. These gains are taxed at the taxpayer's own tax rate in the year of making the gain. Next up is a tax on ordinary income. This is tax you pay on your salary, wages, business profits, and investment income such as rent, dividend, and interest. Then we have GST, which is levied on the sale of many goods and services. There is also stamp duty and land tax. Stamp duty is a state-based tax that generally applies to the transfer of ownership of assets, most commonly known for adding extra costs on property transactions. And land tax is levied annually on the land value of a property. It is also a state-based tax. I often find that new investors forget to factor these extra costs into their purchasing decisions. But it's important to budget for these potential tax costs because you don't want any nasty surprises when finalizing a purchase, or indeed over the course of the holding period. But while tax isn't always everyone's favorite topic of conversation, the ATO does allow for certain tax concessions which could make an overall difference to your bottom line. For example, if your property is negatively geared, you can offset the loss against your assessable income. As a result, a lot of investors actually opt for a negative gearing strategy because of this tax offset. So what exactly is a negative gearing strategy? Well, it's simply the process of applying an investment loss against other types of income, such as your salary and wages. When this investment loss is offset against other taxable income, you essentially reduce your tax bill, which could mean a tax refund on the taxes your employer or business has paid on your behalf. There is a common misconception that negative gearing means making a loss, which means you're out of pocket on your investment. And because of that misconception, it's sometimes criticized as a strategy of losing money to then get back some of it via a tax refund. And sure, it's true that the necessary component of negative gearing is a loss, but importantly, this loss can also be generated by non-cash accounting expenses like depreciation. The best negative gearing strategy, therefore, is one where you're generating an accounting loss, but you still have a positive cash flow whilst the property grows in value. In other words, you're not paying to hold the asset. Let's look at an example. Melanie bought a property for $650,000 and put down a deposit of $104,000. The rest was funded by a loan from the bank. The interest on that loan was 3% each year, and the capital growth rate was the same. The property is in an area with a relatively good rental yield, so she could rent it out for $510 per week, which is an annual rental income of $26,520. The interest expense each year is $17,541, and the property expenses in her first year of owning it totaled $9,617. So in terms of her pre-tax income, she was running at a slight loss. If you took her depreciation into account, Melanie could claim a deduction on the depreciation of her fixtures and fittings, which added up to $8,271, and on the depreciation of the building, which added up to $8,125. By claiming depreciation and deductions for her rental expenses, Melanie received a tax refund of $6,620. which essentially meant she had a positive cash flow of $5,462. So, although her property was negatively geared, she still pocketed money at the end of the day. After 10 years of using a negatively geared strategy and claiming her tax deductions, Melanie's tax refunds totaled $50,320. Besides negative gearing, you could also investigate different tax structures to work out which one would make the most sense for your investment decisions. For example, if you are a PAYG earner on a high income, you could invest in property as a sole owner. This ownership structure would allow you to maximize your tax benefit if you're a negative gearing property, as rental losses are offset against individual tax rates, which could be as high as 47%. But all of your capital gains are isolated in your hands, so you can't distribute gains to other parties to leverage lower tax brackets when you sell. Another ownership structure you could consider is joint ownership. Joint ownership is when 2 or more parties can own an asset either equally or in a designated portion. This is beneficial from a tax perspective because you can split the profits and reduce your tax liabilities. You can leverage the fact that each owner falls under a different tax bracket. So whilst you may not maximize that income tax refund, you could save significantly on sale where capital gains are distributed more evenly. The third ownership structure that you might find makes sense in light of your financial circumstances is a trust structure. A trust is a legal relationship between a trustee and designated beneficiaries. Basically, the trustee is holding an asset on behalf of the beneficiaries. This is great because it offers a significant amount of asset protection, and there's a lot of flexibility in tax minimization strategies. For example, with discretionary trusts, trustees can distribute trust income to different beneficiaries based on their tax brackets. So you could utilize each individual's lower tax brackets. Unfortunately though, this doesn't necessarily apply to all trust structures, so you need to consider that in your decision. For example, with unit trusts, the trustee must pay out income and capital in fixed proportions to interests held by each unit holder. So there's no flexibility to distribute profits, but it does give investors a degree of certainty about their share of return. The one big disadvantage of a trust structure is that you can't distribute negative gearing losses. So the loss will essentially be trapped in the trust until there's enough rental income to cover it. This issue can be mitigated if you have an ability to inject other types of income into the trust, such as business profits and other investment income. If a trust structure doesn't necessarily work for you, you could consider using a company as your chosen investment vehicle. A company is a legal entity that exists separately from its owners, but there are quite a few pitfalls you need to consider. For example, it's a less effective structure for negative gearing because companies can't distribute losses. You also won't qualify for the 50% capital gains tax discount if you sell the property after 12 months of owning it as an investor. Fortunately, your income is taxed at a capped tax rate. The last structure you should consider is a self-managed super fund or an SMSF. An SMSF is a type of regulated super fund which is privately managed by its members. It offers the lowest income tax rate out of all the structures. Ordinary income is taxed at 15% and capital gains are taxed at 10%. And once you reach retirement phase, you don't have to pay any tax at all. But SMSFs are highly regulated, which means you have to comply with extensive laws and strict guidelines. So, those are the different ownership structures you can consider. Here at Myssy Co, we look at property as part of a comprehensive tax planning and investment strategy, which we ensure aligns with the client's overall financial goals. It is important to highlight that the strategy associated with buying property needs to be financially viable in its own right, and the associated tax benefits should only be a consideration, not the sole determining factor of choosing such a strategy. I hope you have found this video helpful as a part of your journey to financial success. Please reach out to our office to organise a time to speak with me or our advisory team about the best path forward for you and your business. Lastly, if you know any business owners who would find this information useful, make sure you share this lesson with them. Thanks for watching.